Let me start with a number that surprises almost everyone. According to the Federal Reserve, more than 40% of Americans enter retirement still carrying a mortgage. And here's the part that really makes people uncomfortable. The average mortgage balance for retirees is over $100,000. If you're watching this and thinking, yeah, that's me, I want you to hear this clearly. You are not irresponsible. You didn't do anything wrong, and you're not behind. This is not a math problem. This is an emotional problem disguised as a financial one. Now, when people think about retirement, they picture freedom, they think of peace of mind, waking up without a paycheck, but also without fear. And nothing disrupts that picture faster than a mortgage payment showing up every single month. So today we're going to talk about how to pay off your mortgage right before you retire or during retirement without wrecking your retirement plan, even if your 401k, IRA, or retirement accounts are the only assets available. And more importantly, how to do it strategically, tax efficiently, and calmly, not emotionally, not impulsively, and not destructively. Because paying off your mortgage can be a great decision if you do it the right way. So let's be honest. Most people don't wake up at 62 and say, I ran the spreadsheets and calculated the optimal internal rate of return and on paying off my mortgage. They say things more like, I just want my house paid off. I'm tired of owing money. I don't want a payment hanging over me. I want retirement to feel secure. And those feelings are completely valid. A paid off home represents stability, safety, control, freedom, dignity, especially for people who live through market crashes, layoffs, or financial uncertainty. So when someone asks, should I pay off my mortgage with my retirement accounts? The honest answer is, it depends. And the worst thing you can do is treat it like a yes or no question, because this is not about eliminating debt at all costs. It's about eliminating stress without creating a new kind of financial risk. Here's the most common mistake I see. Someone retires, they look at their mortgage balance, they look at their 401k, and they say, I'll just take a lump sum, pay this thing off, and be done with it. Sounds simple, and it feels good to get rid of that debt. Feels decisive, and sometimes it's a tax disaster. Here's why. Your mortgage feels like debt. Your retirement account feels like savings. But the IRS sees things very differently. To the IRS, your mortgage is just a loan. Your 401k or IRA is taxable income waiting to happen. So when you pull a large sum from a traditional retirement account, it gets added to your income. It can push you into a higher tax bracket. It can increase how much of your Social Security is taxed. It can trigger higher Medicare premiums, and it can permanently increase your tax bill. All because you wanted the emotional relief of being mortgage-free right now. That's how people accidentally hurt their retirement. So instead of asking, should I pay off my mortgage? The better question is, how do I pay off my mortgage in a way that protects my income, my taxes, and my long-term security? That question leads to a much better strategy. In most cases, the smartest move is not paying off your mortgage all at once. Instead, you pay it off intentionally over several years, often 3 to 7 years. It's almost like doing a Roth conversion, but instead we're doing it to pay off the mortgage. Now, for many people, 5 years is kind of the sweet spot. Why? Because it allows you to stay in lower tax brackets. Helps you control that taxable income, avoid Medicare surcharges, and coordinate with your Social Security. But it also helps you sleep better at night. This turns a stressful decision into a controlled process. So let's walk through a simple example. Let's say you're 63 years old, you owe $150,000 on your mortgage. Your payment is roughly $1,200 per month. You have $750,000 in your retirement accounts. Now, emotionally, you want the mortgage gone. Financially, pulling $150,000 at once could create unnecessary taxes. Instead, what you can do is you could withdraw $30,000 per year for 5 years. You apply it directly to the principal. You stay inside your target tax bracket, and emotionally, you still know this. In 5 years, my home is paid off. Now that matters. Some of the things that they're worried about is if I run out of money, I want to still be able to have a home. I don't want to be homeless, right? And that's why this matters to a lot of people. Most people focus on their mortgage interest rate, but in retirement, the tax rates matter more. If your mortgage is 3 or 4%, but your withdrawal pushes you into a higher tax bracket, you really aren't saving. You're just paying the IRS instead of the bank. Strategic planning asks, what bracket am I in now? What bracket do I want to stay in? And how do I fill it efficiently? Another mistake, ignoring Social Security timing. Large withdrawals after Social Security starts can cause more of your benefits to be taxed, higher effective tax rates, less flexibility, and often the best window to pay off a mortgage is after retirement, but before Social Security starts. That window is incredibly valuable and often missed. Now, paying off your mortgage is not wrong. Wanting to be debt-free is not naive, and wanting peace of mind is not a weakness. But doing it without a plan creates regret. The goal isn't just eliminating a payment. The goal is protecting your income, your taxes, your flexibility, your peace of mind. If this video helped see your situation more clearly, make sure you subscribe to the channel by clicking the button below. We release weekly videos on retirement income, tax strategy, and smart plan decisions. And if you want help building a personalized mortgage payoff strategy, book a complimentary strategy call using the link below. No pressure, no product pitch, just clarity, confidence, and control. Thanks for watching. I'll see you in the next video.